you're talking about doubling the mining industry between now and 2040. I think the other thing I'm going to talk a lot about is Kazatomprom, because I think the market is underestimating the impact of what's happening there. But in the last 2 weeks, something's happened. The market had a little clearing event. Those pounds got placed, and the price has been walking back up. We're right now around 88, $89. Why is the president of France flying around and doing deals with Mongolia and Kazakhstan and Uzbekistan? Because they're worried about security of supply. I often tell the utilities, like, go and buy uranium. I told them to do that 2, 3 years ago. The reality is even if we decided to buy UF6, we couldn't find any to buy. The biggest challenge right now for the whole industry, everything from uranium mining to all the steps of the fuel cycle, it's not about price, it's about time. The other takeaway I would give to you is that the best-selling fund that we have at Sprott year to date is actually the junior uranium mining ETF.
All right, John Ciampaglia. Always fun to talk to you. Last time we spoke was almost exactly to the date 4 months ago, and the spot price of uranium was going up at the time. Funnily enough, kind of at the same level, but only it had gone up to 80. Now it's fallen back down to 80. And your market analyst, Jacob, calls it healthy, a healthy pullback. I don't think my wife sees it that way, but talk to me. Why are we pulling back? Why is uranium not $500 yet?
Oh, don't we all wish it would be $500? But that's not how markets work, unfortunately. Um, I think everybody has to keep it in perspective. I mean, it's not that long ago we were at $60 a pound, and we had a heck of a move there. And I think the move was really driven by very strong fundamentals that aren't going away anytime soon. And you really want the fundamentals to be durable. You don't want it to be a flash and a short-lived spike. We like to think and we hope this uranium bull market will look more like the 1970s bull market, which is, if you look at the chart, it rose substantially. It stayed at very elevated levels, not for 1 or 2 months, but for years. And I think that's the kind of uranium market where the industry needs. It's not just investors. The industry needs that kind of market to play out. Because if we don't have that kind of market condition, we're not going to get the capital in order to make the big investments to actually build new mines.
Mm.
I think it's kind of unfortunate that, I live in Canada, and obviously we've got rich uranium deposits here. And, I recently was listening to the premier of Saskatchewan, where all the big uranium deposits are. And, he was touting that the province had given the environmental permit to NextGen for the Rook I project. And something he said really caught my attention. He said it's the first uranium mine permit that the province has issued in 20 years. And I thought, that is incredible. Like, you're talking about the Saudi Arabia of uranium, and they haven't given out a uranium permit to build a new mine for over 20 years. It's pretty shocking. I think that really sums up in one sentence the state of the market, that it was basically in a state of inertia for such a long time. And I think if you're in that state of inertia for a decade plus, you need to have a decade plus bull market to basically correct and deal with those legacy issues. So as we talk to investors, I think a lot of them get excited about the 2000s, where we had this very sharp rise. But I think people should look very closely at what happened in the 1970s, because I think that's the market that I think that is probably going to play out, where we're going to stay very high for a long time. And the reason is because the demand is going to stay high for a very long time. If I think about, just last week in Brussels, 30 plus countries, doing their photo op under this atomic whatever. It really is a sea change. And the reality is the capacity build out is going to take 10 plus years. And so you would think the underlying demand for the fuel is going to have a similar path, which is going to be, it's going to be a very long process to basically expand production to meet the demand. Clearly that is going to be there, not just for 1 or 2 years, but if you look at the WNA forecast, which I think is pretty conservative, 300 million pounds of uranium will be needed in the year 2040. we might produce 140, 150 million pounds this year. So 100, excuse me, 145. So, you're talking about doubling the mining industry between now and 2040. At the same time, we haven't issued a new permit in over 20 years in one of the richest uranium regions in the world. So something's got to give there. So I think that's what keeps us incredibly bullish and constructive. And I think it's really important why you have to ignore some of the day-to-day noise and the volatility, because I think the longer term trend is clearly up and higher for longer.
Hmm. I want to talk about the supply side of things and how
Mm.
you see it, and just generally maybe structure this conversation in two parts, where we talk about the physical market and then we talk about the equities towards the second half of it. But
Mhm.
you've been relatively, I don't want to call it, you've not been as active in the spot market as for example, at the beginning.
Mhm.
You bought what, um but about £1 million over the last 4 months or something along those lines, if I'm not mistaken.
We have purchased 450,000 pounds so far this year.
Okay, yeah.
We purchased just under 4 million pounds last year, which I think is really interesting, because if you think about the price of spot uranium going up about 90% over that period of time, so from 48 to 88, and we've only purchased 4.5 million pounds, it really tells you where the fundamental demand is coming from.
Mm,
It's not from financial players, it's from utilities. And I
nice.
think people need to hyper focus themselves on what utilities are doing and what utilities need to buy. Because at the end of the day, um, they're consuming 180 million pounds of this material each and every year, and it only goes up 3 or 4% per annum. Financial players, yes, they have a role to play in every commodity market, but it's a much smaller portion. And at the end of the day, utility contracting is really what's going to drive the price higher. And we've seen that. I mean, Cameco told us in late last year that they were offering contracts under long-term arrangements to utilities with market reference prices, which means you pay the market price at time of delivery in the future, and the floor, the minimum price would be $50, and the maximum price was 80.
Mm,
That was like October, November. And then they told us, oh, the price is now 60 to 90. Now the price is 70 to 100. Now the price is 75, 80, maybe 130. They suggested are going to be the new ceilings. And if you think about it, if you're a uranium producer and you're saying, look, I'm going to deliver this uranium to you in 3 or 4 years or whatever the window is, and we're going to cap the price at 130. I mean, that's a pretty good indication of where you think the price is going to eventually gravitate to.
mm,
So, more recently, we hit a little bit of an air pocket in the spot market. We raced up to $106 a pound, and that was really on the back of the Kazakhs announcing. I think the other thing I'm going to talk a lot about is Kazatomprom, because I think the market is underestimating the impact of what's happening there. Maybe I'll start there. So if you think about every bull market in a commodity, it eventually dies or runs out of steam because you get an outsized supply response. High prices incentivize more production. More production basically pushes the price down. It's classic, right? So if you think about the supply response in uranium so far, what's happened so far, what is likely to happen in the next few years? We are getting a supply response. We're getting a flurry of new mines, or excuse me, we're getting a flurry of restarts of old mines. And we're obviously getting a bunch of mines that have been basically stuck, not mines, excuse me, deposits that have been stuck for a long time, finally starting to move through capital raising and feasibility studies and environmental permits and all that good stuff. But you would think that the largest producer in the world, the lowest cost producer in the world, is in the absolute best positioned
mm.
to flex production to capitalize on the higher prices and take market share away from other competitors. Now, what did Kazatomprom tell us at the end of September last year when the price hit $72 a pound? which coincidentally was the price right before Fukushima in 2011, $72 a pound. They said in September, we're going to flex production over the next 2 years, which is going to translate into 8 million more pounds hitting the market in 2024 and 16 million more pounds hitting the market in 2025. That was, I think, September 29th. Well, fast forward to middle of January, and they basically said, not going to do it. So the fact that in 4 months, they basically walked back all the production increase for 2024, we expect flat production this year from them, is pretty meaningful because, other than McArthur River restarting in 22 and really ramping in 23, we haven't had any meaningful supply response. And just to build on Kazatomprom, they also said in March, we're not going to tell you what our 2025 production is going to look like. That was a typical period where they would provide some kind of guidance at the March analyst meeting for the following year. They told us, you're not getting any guidance from us until August of this year for next year. That to us suggests probably going to be more surprises in terms of production. So I'm going through this in a lot of, time-based, events and news items, because I think the sequence is very important, that the world's largest producer has walked back production. Now, why haven't they been able to flex up production? Well, they told us initially it was sulfuric acid issues. Obviously, sulfuric acid is the key reagent they use to dissolve the uranium. But more recently, when I was at the Bank of Montreal mining conference in February, representatives there were telling institutional investors, no, it's not a shortage. It's actually, we didn't want to pay up for the sulfuric acid. There is no shortage. That obviously caught a lot of investors off guard and confused them, because it's like, hold on a second. You just told us a few weeks ago it was a shortage. Now you're saying there's no shortage, but you didn't want to pay high prices. So I think from the institutions we've talked to, and I've talked to probably 100 institutions since that time, many of them have said, is it really a sulfuric acid shortage, or is it a value over volume strategy, which means they're curtailing production because they want to keep prices higher for longer? And I don't know the answer. And I don't think we're going to know the answer until later this year. I think the bottom line is we're not going to see any meaningful production out of them, incremental production this year. And we're not very optimistic they're going to be able to flex up production meaningfully next year either. So, so that really leaves all the brownfields. And, we have a good chart in our presentation that shows all the brownfields restarting. It's really healthy for the industry, getting Boss and Paladin back online, obviously getting McArthur River back online. And there's obviously a whole host of other smaller companies that are restarting mines. But if you look at the collective amount of those pounds, with the exception of McArthur River, there's no single mine that is going to produce more than, say, 2 or 3 million pounds in the next 2 years. So collectively, they all help. They absolutely help. And they clearly disproportionately help the companies that are getting back to production. But I think when I heard that the McLean Lake mine was restarting, I kind of thought to myself, okay, we've covered everything. Like, we've covered every brownfield just about, because that was a mine that last produced 15 years ago. So what that suggests to me is just about every brownfield that is produced in the past that has any chance of producing again is probably there, which suggests that the price of uranium at, in the high 80s right now, and obviously term prices are much higher than that, can operate, has a cost curve below current pricing in both the spot and term markets, which is really healthy. For the last 2 years, everyone's been waiting. When are we going to get these restarts? We're at 50 now, we're at 60. And more recently, since March, it's just been a wild ride in terms of, all the news announcements and all the developments. And obviously, we still have all kinds of things happening with sanctions and bills and that we can get into as well. But it's been a pretty wild 3 months.
That's exactly why I wanted to talk to you, because it is being a wild period. And I'm thinking about how that's specifically influencing your purchasing strategy. I mean, you said 4 million pounds last year. Sounds like a lot. Still not the spud that tripled its holdings in about a year or so in 2021, of course, but definitely something, right? So why is that? Like, what's driving your purchasing decision right now? Is it the availability of pounds on the spot market, or is it something strategic within spot itself?
Yeah, so it is a very simple explanation. So we can only issue new units of the trust if it's trading at a premium to its net asset value.
Hmm.
And we have not been consistently trading at a premium to its net asset value, which has limited our ability. We've been very close on a number of days just recently. The trust is trading pretty well, like in terms of where we are right now. Or, we've been kind of gyrating between 1, 3, 4% discount to NAV. So all you need is a little bit of buying tension or some kind of positive news development to kind of pop you over the NAV. And that gives us the ability to go into the market, issue new units. The other thing I would mention is that the trading volume of the trust has grown exponentially, which is really important. I mean, there are days where it routinely trades 100 million plus dollars in volume. Some days it hits $200 million. We're not issuing necessarily units on those days, but it's important because it's allowing institutions to come into the trust in big volume and size, which is important. Now, the other thing I would mention to you is that we've got investors that have been in the trust for 2 years, 3 years, 4 years. Some of those investors, I suspect, have taken some money off the table because they've doubled or tripled their money. And I think it's natural. We've had some rollover or transition of the shareholder base in Spot. Some of the very early investors we had who were really, really sharp identified the investment thesis in uranium in 2021. They helped us buy 22 million pounds in 2021. I think our average cost was $42 and change.
Hmm.
Those guys benefited hugely. And, look, they doubled their money, and I don't fault them for taking some money off the table. So we have had some rotation of shareholders. Some of the early kind of specialty funds that were more nimble, that got positioned early. I think they've handed some of their shares off to larger, more generalist investors that have really dominated most of our discussions over the last 6 months or so. It's interesting because we did so much education in 21 and 22 about uranium 101, fundamentals of the market, how does it work, the fuel cycle. And I can tell you that I'm right back with my team in the exact same spot right now. And
Hmm.
what I mean by that is we do an incredible amount of educational marketing. And this year, I can't remember a time that's been busier. And what I often find is that I spent all day doing Uranium 101 to institutional investors. So some people say, well, is the crowd traded? Everyone knows about this. Absolutely not. Oh my gosh. I mean, I'm doing Uranium 101 all the time with institutional investors.
Hmm.
And that's good. I mean, it's boring for me sometimes, to be honest with you, but it's important because we have to constantly, feed the market with, information so that we can attract more institutional investors, newer institutions. And the other point I would make is, okay, some of our early investors who bought in at the equivalent of $40 or $45 a pound uranium, I don't want to lose sight of the fact that they're handing their shares to another investor who's, guess what, buying their shares at the equivalent of 85 or 90 or whatever dollars a pound. So we've got new investors that are coming into the trust that are buying in at 85 or $90 equivalent. So, people say, well, we hit $100, is the bull market over? It's like, not a chance. Like, $100 is really nothing. $100 is basically where we were before Fukushima in 2011. If you just simply apply US CPI to the $72 price, it's $100. So where are we in the spot market today? So we raced up to 106 on the Kazakh production surprise. We've walked back the last 2 weeks. We hit $84 2 weeks ago. We hit an air pocket in the market where I'm going to describe it as a buyer strike, where we had buyers, as the price broke through $100, step away from the market. Now, why did they step away from the market? Because they have the ability to at any time. Remember, utilities are not running natural gas plants where you have to source natural gas every day and burn it. You're sitting on your uranium in the reactor core that can go, 12, 18, 24 months. you're probably sitting on another reload of fuel at the nuclear power station, which goes an equivalent amount. Plus, you've got uranium in all kinds of different forms moving through the fuel cycle. You don't need to panic. Okay. So it's easy for utilities to step back. They're not financial players. They don't move quickly. The procurement process for them is quite extensive. You got to remember they're coming to market, and if they're signing a contract or making a decision to buy 5 million pounds of uranium, you're talking about a lot of money here. These things don't happen, overnight, and they don't happen in a knee-jerk fashion. So the spot market is a much smaller market. And when we hit a bit of an air pocket there, we didn't have any buyers. They stepped away. We didn't have any cash to deploy. We bought 50,000 pounds at $84 when the market kind of troughed. But in the last 2 weeks, something's happened. The market had a little clearing event. Those pounds got placed, and the price has been walking back up. We're right now around $88, $89. And we've seen some buyers step back into the market. We don't always know who they are, but we clearly saw the price hit 84, and that incentivized people to come back. So in the short term, yes, you're going to hit these air pockets. One thing I want to explain to people, it's really important. When we go buy gold for our other products, I can go and buy $100 million of gold in minutes. We can call a whole bunch of bullion desks and we can get huge amounts of gold. Why? Because the bank is able to hold the inventory and completely hedge it with futures contracts. Okay. Now, if I go to a trader and I try to buy $100 million of uranium, the answer is we don't have that inventory. Why? Because there's no hedging mechanism. So this is a very important distinction in uranium. A trader can only hold a fairly modest amount of inventory on balance sheet because it's not an easy commodity to hedge because there's no active liquid futures market. So we find at times these traders, when they have material and they're being told from above, get it off the books, sometimes, they come to market, they need to clear it, and they just have to find that clearing price. And I think we saw that event 2 weeks ago. So it's a little bit different. I know it's frustrating when it happens, but it obviously works both ways. When the market's tight and there's buying tension and there isn't a lot of inventory, we've obviously seen the price of uranium jump $5, $6 a day, even $8 on some of the Kazakh related news. So it is the nature of the beast. It is going to be a little bit more volatile, but that's what we've seen in the market. We feel like we've hit kind of a floor here. The market's kind of settled out. It's calmed down. But I want to remind everybody, it's had a big move since September at $60. And it has to kind of, I think, a healthy bull market is one where you have these corrections along the way, you consolidate those gains, and you kind of build in kind of a staircase fashion. The other thing that I've been trying to remind people is we've talked to a lot of institutional investors that said, oh gosh, why didn't you tell me about this 2 years ago? I missed it. Hey, you got an entry point. You've had a correction in the market. The fundamentals haven't changed whatsoever. And these little sell-offs provide attractive entry points for people that I think missed the first stage of the bull market. And our belief is we're just entering the middle stages of this bull market, and there's still a lot of runway to go.
How do you deal with that volatility within the fund is something that I'm thinking about, specifically the buying strategy. I mean, as far as I understand it, when you started out, the idea was to just buy on the spot market, which, I mean, in your opinion, you don't think it's the 1 year market, but you think of it more like a market where you can get physical title of the drums of yellow cake within 30 days. Let's start there. Is that still the strategy, the idea for you here?
Yeah, our strategy has not changed one bit since we launched the trust. We want to raise capital when the trust is at a premium to NAV, take the capital and shop the market for the best available offers. So what does that mean? Well, it's about price, it's about delivery windows, it's about location. Where's the material going to end up, or where is it currently residing? We've always preferred to take title or purchase uranium and take title of that uranium in the shortest period possible. So as you mentioned, the typical transaction would be for us, we buy from trader X, we transfer title of those drums at a facility in Canada or France or the US. And that all happens on a book-based transfer within 30 days. Now, the counterparty risk to us is almost nothing because there's obviously a general terms and conditions contract underpinning the transaction, but more importantly, the drums are already sitting at the conversion facility. You're not buying drums, or you're not buying uranium that still may be in the ground, right? Like if I bought uranium with a 1-year delivery window, where's the uranium today? It's probably in the ground.
Mm.
So now you're taking on production risks, shipping risks, and God only knows what could happen given sanctions, insurers unwilling to insure Class 7 vessels. So we've really, in the last 2 years, shifted our buying strategy to become even shorter in terms of our delivery windows because we just don't want to take undue risk, just given all the uncertainty in the world right now with sanctions and Russia and whatnot.
Huh. That's it. Well, I understand the risks there. But I'm thinking, could a change in that approach maybe help you sort of fix that prolonged discount that you've had to NAV? As in, there's risks, but there's also, I mean, in the long-term market does offer you price stability and maybe predictability, as knowing, as in, knowing that the pounds are going to be there once you need them. And that's not the case if the spot market dries up and you cannot find any pounds. So yeah, talk to me
Yeah,
about
I
that.
mean, yeah, look, it's a fair point. I mean, generally what our strategy in the past when the market was we couldn't find pounds. We have in the past when we were buying significant amounts of uranium, we did walk out the delivery windows. I think the longest we ever got to was 6 months,
Hmm.
but most of our materials generally been 30 to 90-day delivery windows. And just speaking about the discount, I mean, obviously we focus on it every day. It's very important to us because we want the vehicle to track as closely as possible the spot market. Now, it's impossible because this is a closed-end fund. And at the end of the day, the sentiment in the sector and the amount of buyers versus sellers and where we are in the market cycle are going to have the most influence on where we are. We've noticed a really, I talked a little bit about the shifting shareholder base, and one of the dynamics that we've noticed is, in the early days of the trust, like the first couple of years, we noticed we had a lot more momentum. We call them momentum investors. It's a label we've used to describe a group of investors that saw the investment thesis and said, "Look, we want to give you fresh capital so you can go and buy more uranium." Great. What we've noticed in the last year and a bit is that we've had more generalists coming in, and generalist investors, we call them more value buyers. They're more value oriented, meaning they want to buy the trust at a discount to NAV, not at a premium. And I think it's part of their wiring, and I think it's just part of their approach to, well, why wouldn't I buy uranium at a discount to NAV? So we've noticed these folks have been more active in the last year or so in terms of buying the fund at a discount. Now, that's helpful because they help to close the discount. And if you look at the chart of Sprott NAV versus market price, you'll see it'll dislocate for a period of time. And then a month or so later, it kind of goes back to NAV or close to NAV. And that's because value guys come in and they view that short-term dislocation and they say, well, why wouldn't I buy uranium on sale below spot? And so you need both in the ecosystem. I just think in the last year, we've had more value buyers emerge than momentum buyers that were, I think, the first movers in the trade. But, like I said, as a fund grows and seasons and shareholders come and go and rotate, I think that's just a natural process.
Hmm. What I'm also thinking about, or where this question initially was born, if you will, was looking at what France is doing with Mongolia. Just
Mm.
going way out of their way to secure uranium in the case that the spot market dries up. That's not, as far as I understand, that's not something you would ever be interested in right now, or I mean, ever.
No, I mean, our strategy is simply focusing on the spot market. We're not a utility that has, the requirements for tens of millions of pounds over the coming years. But I think you raise a really interesting point, which is, why is the president of France flying around and doing deals with Mongolia and Kazakhstan and Uzbekistan because they're worried about security of supply. That's why. Niger has obviously been one of the primary sources of uranium for the French nuclear fleet, which is still quite sizable. The French want to keep building. And, based on what we've been told, no uranium has left Niger since the coup, and there's very little activity happening at mine site. And nobody knows when the situation will be resolved. So France, rightly so, is trying to be proactive and saying, okay, if we can't get access to the pounds from Niger, what's our plan B, C, and D? And that's what everybody's trying to figure out. It's the same thing that utilities around the world are trying to sort out, whether it's what's our source for uranium, what's our source for conversion, what's our source for enriched uranium. Everyone's trying to figure out the way forward, given the market has really started to shift and governments around the world are clearly signaling that they want their respective utilities to move away from Russian origin services. So we still think this is something that is something to watch very closely. The U.S. sanctions, which, just to go back a little bit, the sanctions in the U.S., I mean, this is not new news. This has been in the works for 2 years. But when the House passed the sanction bill in December, that got the market very excited because it all of a sudden started to feel real. Now the bill obviously stalled in the Senate, and there's another bill trying to work its way through the House. I thought it was very interesting that Department of Energy Secretary Granholm just this week basically put out a pretty stark public warning saying, hey, we want this bill passed in the House because we want to essentially avoid having to go down the path of executive order if this thing does not get resolved. So when I think when the DOE is basically saying we want this bill passed the Congress, it really signifies how important this transition is going to be in terms of weaning off of Russia. And you know what? Prices of conversion and enriched uranium have obviously gone up exponentially in the last 2 years in anticipation of this happening. So again, this isn't new news, but I definitely think it makes it real for utilities. There is a waiver process, but we've been told the waiver process is uncertain, and it's also public, I've been told, which is kind of interesting. It's almost like utility has to go and make their petition to the DOE on why they need to continue to take delivery of Russian enriched uranium. And apparently it's a public process, so I almost get the feeling it'll be like a bit of a public shaming process for a utility having to make the request. So I think utilities are going to try their best to not have to go down that path of the public waivers.
Have you done in the meantime? Have you done any institutional swaps since we last spoke, where you sort of get a producer that's not a primary uranium producer or something like that to give you physical pounds in exchange for trust units to sort of again go around the risk of the spot market, if you will?
We haven't done one of those in a little while, and I think the easy answer is we've basically done most of them. Meaning most of the hedge funds that hold physical out there, many of them since 2021 on have done that exchange with us. There are a few hedge funds, obviously, that still own physical themselves. I would say that what we've been more active doing is location swaps and origin swaps. And what that basically means is a utility will come to us and say, hey, would you swap me 500,000 pounds at location A, and I'll give you 500,000 pounds at location B, and I'll pay you 50 cents a pound or whatever it is for that service. And we're more than happy to do those transactions with utilities and producers because their inventories are in the wrong locations. And since the ConverDyn facility reopened in the US last year, there's been a lot of market participants that need to get material at that location. We just so happen to have millions of pounds there. So why I'm bringing this up is it's a value-added service that we do for the trust. If we're able to generate a couple $1 million a year doing this, that primarily goes to the benefit of the trust and helps to offset the overall costs of the vehicle. And as the industry gets kind of started up again, some of these facilities that have been on care and maintenance a long time, we've been getting a lot of requests to do these. So it's important to do. We've swapped a couple million pounds already this year, and we're always getting inbounds to do more.
What about the other way around? Are you getting any of those inbounds? Like, would you ever give physical pounds to, say, Cameco if they asked you to borrow them without sort of starting a shareholder vote or necessarily announcing that to market?
Yeah. So no, we've never lent out a single pound. We won't. I think I'd have a shareholder revolt on my hands if we did such a thing. So we're more than happy doing location swaps, helping out people, and origin swaps. Believe it or not, sometimes people will come to us and say, would you swap us, I don't know, make it up, Kazakh origin material, and
Okay.
we'll give you Canadian material. We'll pay a fee for that. We've done a couple of those too, but no lending of material. That's off out of scope for us.
Okay. And that's gonna stay that way, or does it depend on what's in the contract?
So the trust the trust has the ability to loan out material, and to be totally frank, it was just language that we imported from the predecessor vehicle. But we've been running these vehicles for 14 years, and we've never lent out a single ounce or pound of any of our
Hmm.
commodities. It's not something we are open to doing. It just doesn't make sense, particularly like if you think about it too. When the uranium market was kind of stuck with a supply overhang in 21 and 22, there was no real point of loaning out material. Why would you want to loan out material when the market is trying to figure out how to deal with secondary supply? So it's not something I think our shareholders would really approve. I think they want to keep the material sequestered in the vehicles for as long as possible.
I think it'd be way worse than just not approve. I think a lot of people would be pissed off. So I'm happy with this answer here. And why I'm asking all these questions is because I'm also thinking about um again, the competition for sourcing physical uranium, and I mean outside of the utilities, because it's being said, or I read somewhere, that there are over 50 parties that are now buying and storing uranium. I don't know if that's 50 financial players. I don't know how their funds are structured and whether they say something to market. I don't think anyone says as much as you do, or shares as much as you do. But are you feeling that competition in the spot market, or when you talk to investors, or anywhere else?
Yeah, we read that article that you're referring to, and we channel checked that and confirmed it was fake news.
Okay. So how many
Yeah,
do you think
there's
there are
nowhere
out
near
there?
50. There's nowhere near 50. There are some. I would think it's a handful,
Okay. So like 10-ish?
10 or less. Yep.
Okay, 10 or less. Good. Well, I didn't know that. How did you fact check that? How do you know?
We have our ways.
That's one way to answer it. How far are you then willing to go in the spirit of competition? Like, do you get into bidding wars or offering better contract conditions or something else? And do you have the upper hand? How does that work?
No, I don't think any of those points are really relevant. I mean, look, when we were raising a lot of capital, yeah, sure. I mean, the market is competitive. But a lot of the material that we were buying was really material that was sitting in somebody's inventory, whether it was a trader or a hedge fund or even a utility or a junior miner, or material that just comes to the market through offtake agreements.
Mm,
And nobody was interested in buying it at the time. Like everybody, the thing that I find amazing is that the whole industry knew there was a supply deficit, right? Uh, Everybody should have known that at some point you're going to run into a problem, where primary production is not going to keep up, and you're going to run down your inventories. And I feel really great on behalf of our shareholders that while no one was watching, we bought a lot of uranium at very low prices on their behalf.
mm.
And it's a free market. And I often tell the utilities, like, go and buy uranium. I told them to do that 2, 3 years ago. Some utilities did. Some utilities ignored the market signals. I can tell you unequivocally. I mean, we would talk to them, and they just thought the whole thing was an artificial price increase. They just ignored the fundamentals. They just thought that an era of plentiful uranium was going to be there forever for them. And you know, we had a different view and a different thesis. And I think the challenge that some of them fell into, or the trap some of them fell into, was they thought it was going to be like a replay of the 2000s. And the 2000s playbook was the commodity price went up very high. A lot of them said, well, you know, all these hedge funds came to the market in the 2000s and the price went up a lot. And then the financial crisis happened, and guess what? They sold it all to us, and everything was back to balanced. And you know, that's all going to happen again.
Mm,
And you know, we would say to them, look, you need to like listen to what we're telling you. This is a perpetual trust. We're not. This isn't a strategy to buy uranium at $40 or $50, wait till it gets to 100 and sell it to you. Like Sprott has no financial incentive to sell any material or shrink the vehicle. We make money if it gets bigger.
mm,
So I think it was a real disconnect. And I could tell you, I mean, I went to an industry conference in May of 2022 in Montreal, the Nuclear Energy Institute Fuel, whatever it was called, Fuel Conference. And I went up on the stage because I wanted them to hear it directly from me on how the vehicle worked. And I went up on the stage and I did a presentation and I said, look, this is how it works. Very simple. It's very transparent. This is what we're doing. It's a perpetual vehicle, blah, blah, blah. So you really should go and buy your own uranium because don't think you can rely on our shareholder inventory. And I kid you not, I got off the stage. I walked in the lobby of the hotel and I had some utility guy, I don't remember who it was, but he pulled me aside and he said, I just heard you speak. I said, okay, great. So he's like, you're not going to sell us all the uranium. I said, I just said that 5 minutes ago, didn't I? And he's like, you're serious. I'm like, yes, I'm serious. Like, this is the kind of conversations you'd have with some of these folks. I think the understanding has obviously changed dramatically in the last 2 years, and it reflects the utility contracting cycle finally, you know, reversing after a long period of demise. You
mm,
know, last year, you know, there was a lot of excitement about the 160 million pounds that were contracted.
mm,
But if you got to really pull those numbers apart because, you know, 160 million pounds, people say, we're at utility replacement rate contracting. That's exciting. But I think if you pull the numbers apart, a couple of really interesting insights come out of it. One, 60, I don't know how much got booked, but somewhere between 40 and 60 million. I don't know what the pricing reporters ultimately did, but somewhere between 40 and 60 million pounds of that number was just the Ukrainians doing this one-time super purchase with Cameco,
mm,
which was them basically transitioning away from Rosatom. Okay, so that's a one-time anomaly. Is that contract, I think, was 10 or 12 years. The other thing I would point out is that the U.S. utilities only bought, I think, 20 or 22 million pounds last year. That's way below replacement rate contracting for the U.S. utilities, which require about 50. So yes, a lot of excitement about the 160 number, but within that 160 number, I think there's a couple of really interesting takeaways. And you know, our belief is that the contracting cycle is only going to accelerate. We've been saying that for 2 years, and it is playing out as we have predicted. Now, Per Yonder, our technical advisor, I just spent 2 days with him doing virtual marketing to funds in Brazil, and last week I did 2 days with the Bank of Montreal doing marketing in Canada. And you know, his comment to the institutions that we spoke to was he's never seen the amount of term contracting activity this high in his 20 years in the industry.
mm.
And that's consistent with the realities of security of supply, potential sanctions, and running down your inventory for a long time.
What do you,
So,
yeah, go
go
ahead.
ahead.
I was just gonna say, what are you seeing? Because you're reminding me of what you told me last time as well about the U.S. utilities. Is in what are you seeing with the conversion market? Because again,
Mhm.
last time we spoke was 2023, so we were talking about whether or not we'd reach replacement rate contracting, and you told me that we were reaching it, but only sort of on a global level. Whereas the U.S. utilities weren't contracting as much. That still appears to be the case so far this year. Um, but could it be that they are not contracting as much because they have no way of enriching or converting the uranium? And what are you seeing in the SWU and the UF6 market?
Yeah, well, I mean, the whole nuclear fuel supply chain, all the different price points and forms of uranium are at crazy high prices. I mean,
Hmm.
conversion prices are incredibly high right now, reflecting the scarcity of conversion and enriched uranium prices remain incredibly high. Last year, it's interesting because just to take a step back, last year the prices for conversion and enriched uranium were, they went up a little bit. It was the year before they went up exponentially, more in reaction to the war breaking out. And remember, in 2022, uranium only went up, I don't know, 12 or 14%. Everybody was pulling out their hair saying, what's going on? Why is conversion and everything else going up so much? And uranium was lagging. And then last year it was the reverse, right?
Yeah.
Uranium went up 89% because, again, um, it always trickles down from the top of the fuel chain to the bottom, and the bottom of the fuel chain is U3O8. So now they all seem to be, kind of moving more in unison. But I think it's good, prices are going to be high for very well, for the foreseeable future, because everyone is trying to figure out how to reshore the supply chain away from Russia. There have been announcements from Urenco around increasing capacity in New Mexico. They've increased capacity at their plant in the Netherlands and Germany. Converdyn has finally reopened. Cameco is running full out of their conversions facility. I read a story this morning saying Orano is considering opening up an enrichment facility in the United States, which is really interesting. So this reshoring is happening. The issue is these are very, technical, complicated plants. You just don't whip them up overnight. They can take 2, 3, 4 years to build. So it's happening. The investments are being made. The investments are typically multi-billion-dollar investments. And the only reason these investments are being made is because the respective governments and nuclear agencies are telling their utilities, you've got a limited time uh, left in terms of transitioning away from Russia, and that's clearly happening.
Hmm. You haven't traded in UF6, yeah, since you initially bought the participation fund in what 2021. And what you
Mhm.
told me last time was that you didn't like it because of how challenging it was to sell it due to the overall tightness of the market, but also how complicated it is. And you also told me that you just want to keep the spot vehicle simple. But given what you're telling me here and the moves that we are indeed seeing in terms of enrichment and conversion as well, um, it sounds like there might be an opportunity to maybe generate, some better returns or something along those lines. Maybe even differentiate from those 10 or how many other competitors that are out there. So would you ever start up a new fund or change spot to add UF6 and EUP?
Um, well, you're right. We had a little bit of UF6. We inherited it, and it took us about 6 months to sell it. Just to, which is a really symbolic, because the market was just, this is obviously before the war broke out, but the market just didn't need it. The reality is even if we decided to buy UF6, we couldn't find any to buy. I mean, it's all sold out everywhere. We've heard many stories that the conversion facilities are basically have pre-sold their production for the next 2, 3 years.
Really?
So not only is the price high, but it's incredibly scarce. And the other thing too is I think the utilities would be pretty upset with us if we started to accumulate it, because it is something that has been the primary bottleneck for them. And it's just something we don't want to create a fight.
Hmm. Uh, but do you think that if, well, it eventually gets resolved. I was going to ask you, do you think it gets resolved? All issues get resolved one way or another, typically through price. But is that when the American utility, the U.S. utilities are gonna get more active in the market, or how do you see that?
Well, they're super active in the market. I mean, it's one of the reasons why people are asking us for our uranium at the Converdyn facility,
Hmm.
because we've got inventory there. Everybody wants to gasify it, right? So um, I just don't, you're right. I mean, you made an interesting comment about price fixes everything. I actually gonna add to that. I think the biggest challenge right now for the whole industry, everything from uranium mining to all the steps of the fuel cycle, it's not about price, it's about time.
Hmm.
Because right now, the price of uranium could be $300 a pound, And I don't think it's going to meaningfully change the market's ability to supply more material in the short term.
Yeah. Yeah.
It's
Well,
time. Time is really the issue, and time is has become such a factor because so much of the industry was shut in for so long, whether it was a mine or whether it was a conversion facility in Illinois that didn't run for 5 or 6 years. It just takes time to get these things up and running again. And what we've discovered is that whether it's a mine or a processing facility or a mill or whatever, these machines are complicated. You don't run them for 5 or 6 years, you turn them on, and guess what? Things break or things don't work, and it takes time to kind of iron out the bugs. So I think price ultimately fixes a lot of things, but right now the industry is struggling with time.
hmm, that's a great way to put it. That's something that also differentiates uranium from things like, say, lithium or something like that, where you
Mhm.
can, put in a lithium brines project in South America into production way quicker than you're going to put, an underground uranium mine in Saskatchewan that's like 900 meters deep into production, right? So there's that. But okay, so no UF6, no SWU fund to come. What about a redemption mechanism on this fund? Are you still pursuing that?
Yeah, great question. So we announced last September we were considering one, and that was just because well, we weren't happy with the way the trust was trading relative to NAV. I think it's fair to say that last July was the low point in terms of investor sentiment that we've seen in uranium for a long time. And so we floated the idea of putting in a limited redemption option. And that was in September. We talked to a lot of different institutions. I would say generally we got pretty constructive feedback about it. And then something happened. The market took off and the trust started trading better. And sentiment shifted again to, we don't need it right now. So we made the decision in January to take it off the table for the time being. And that was because the process for us to implement it is not just an arbitrary one. We need to go to shareholders and get their approval. And at the time, we just didn't think that shareholders would support it. And to be totally candid, we have two camps. We've got one camp of investors that say, yes, it would be helpful to manage the discount. We've got another camp of people that are saying, you know what, we don't want material going back into the market. And it ebbs and flows, in terms of where we are. Right now, as I said, we've been trading at kind of 1 to 5% discount. That's, that's in line with what our other trusts are trading at right now, in much bigger liquid markets. So I think that's a good reflection of good sentiment right now in the uranium market. All I can say is it'll never come off the table, but it's on the back burner right now because I do think longer term it makes sense. It's just a matter of when and how to implement it. So it's something that is definitely up for consideration if market conditions change.
Hmm. Looking at some of the other funds that you're mentioning, the physical gold or the physical silver
Mhm.
trust, they also haven't been at a massive premium to NAV like they were in 2011. Is that the state of the market, or has something just changed within the functioning of these funds?
It's the state of the market.
Okay.
If you look at all the gold ETFs around the world, up until maybe 2 weeks ago, they've been steadily in net redemptions.
Hmm.
So irrespective of the gold price finally kind of breaking into new highs in US dollar terms, today I think we're at another new all-time high. We have not seen yet, other than a few little green shoots in the last week or two, we have not seen investor capital in the West come back into gold. Where is all the gold buying coming from? Well, it's coming from two sources. It's coming from central banks, which guess what, are becoming increasingly nervous about holding US dollars after they saw what happened to Russia's foreign reserves getting seized. And gold is the preferred foreign reserve. So we've seen a lot of central banks accumulating gold, I think, as an alternative to the US dollar. China obviously is acquiring lots of gold. And I'm going to make a comment about China because China in the past was very secretive about how much gold they were buying. I'm not talking about retail. I'm talking about the central bank. They were always very secret about it. They would maybe tell you every 2 years what their stockpiles look like. And what I find really interesting is they're telling the market on a much more frequent basis what their gold holdings are. And I think there's clearly sending a message here about what their intention is in terms of moving away from the US dollar and shifting it into a hard asset like gold. Chinese retail investors, I think, have become very active in gold again for a couple of reasons. One, the real estate bubble has finally burst. So all the capital that was chasing real estate, speculating in real estate, that has obviously not fared well for Chinese investors. Chinese stock market has not fared well, and we think investors are going back to traditional stores of value like gold.
Mm.
So we see central banks and Chinese investors buying gold. We see Western institutional investors and Western retail investors largely selling their gold for the last 2 years and it moving east. This happens all the time. Now, at some point, we think there's going to be an inflection point and there's going to be a switch back in terms of Western investors buying gold again. Now, why haven't they been buying gold? Well, there's $6 trillion sitting in US money market funds making 5% right now.
Mm.
I think that has a lot to do with it. When interest rates start to come down over the next 2 years, and they're going to come down slowly, and that 5% yield goes back to 3% or whatever number it ends up settling at, that is obviously going to unleash a whole bunch of capital looking for new homes. Some of that is obviously going to go into gold is our belief, but it's obviously going to go everywhere. But if you look at the best-selling categories in the last 2 years, it's been money market and fixed income because people just are looking for 5 and 6 and 7% yields again, waiting out the Fed. So we think gold is at an inflection point now. It's at an all-time high in the US dollars. Obviously, it's hit all-time highs in almost every other currency. The US dollar was the laggard here. And we're finally starting to see some green shoots in terms of flows going back in. For the Sprott Physical for the Sprott Physical Gold Trust, we've seen in the last few weeks the discount to NAV tighten up to around 1%. That to us is another sign of interest coming back into the gold space.
Mm.
So we would expect that this is going to continue to improve, particularly as the Fed starts to finally cut rates as opposed to just talk about cutting rates, but cutting rates. And we think we're at a clear inflection point. Gold is going to be the first mover. That's what's happening. But we think the other metal to follow, and it's usually 6 months or so later, is silver. Silver has been meandering around at mid-20s for a long time. We've seen some signs of life out of silver, but we think silver is gonna follow gold in the coming months.
It's interesting. You told me before the call here, we were chatting, and you told me that on some days you have like a dozen meetings or something along those lines. Obviously, your gold and silver funds, large vehicles, well established, have existed for a while. Which of those funds, adding the uranium and the copper stuff that you're also doing currently, which of those funds is taking the most of your time or that people are asking the most about?
Undoubtedly, uranium has taken the vast majority of my time for the last 2 years plus, for sure. And I would say since September, it's only accelerated. And the reason why I say September is I don't know what I can guess what the catalysts were, but since September, the number of institutions and the types of institutions and where they're geographically located has really expanded. The first, as I mentioned, the first movers into the space were more specialty funds. They were more nimble hedge funds. But since September, we've had more mainstream, institutions, more generalist type of investors, even more larger commodity and natural resource type investors who largely ignored uranium for a long time because there was no reason to invest in it, have been re-engaging with us and saying, look, I need to get up to speed with uranium because I can't just ignore it anymore. But we've definitely seen some green shoots in terms of gold. Silver's been still quiet. And the other commodity I would say we're getting an increase in interest of late has been copper. Copper, I think, is starting to break out. And I think copper is almost like where uranium was 3 years ago. I mean, everybody could kind of see the structural supply deficit building. The price was still quite low. incentive pricing to build new mines is materially higher than where we are today. And it feels to us like copper is the next metal to kind of go through a multi-year bull market.
Mm.
So I've had a lot of discussions with institutions about copper of late.
I do want to hear a word about that sort of towards the end, but this is sort of within the topic of the physical uranium. I also said that I wanted to talk about the uranium equities, if
Mm,
you will, because last time we spoke, you told me that you guys were seeing sort of a rotation of capital from Sprott into URNM and URNJ, but both of
mhm.
those ETFs have since stayed flat since we last spoke, but Sprott is up. And then some of the other funds are also doing well better than URNM and URNJ. So what's happening with that rotation, and where's money flowing to right now?
Sure. So just for some perspective, so last year we looked at all the uranium related vehicles in the world, and the number we came up with was around 600 million US dollars went into uranium mining equity ETFs. And those would be ours and all the different competitors. As far as the physical uranium vehicles around the world, we counted about $400 million. And most of the money came from August on. You know, the market was very out of favor for the first half of the market. So about $1 billion came into the market. What I also find interesting is this is a sector in the market that stocks went up 50 something percent. The commodity went up 89%, and global flows into the category in the ETFs, anyways, in the closed-end funds and whatnot, was only $1 billion. You know, you think about how many billions of dollars went into like 20-year treasury funds and technology funds. It's just like a drop in the bucket, irrespective of the outperformance relative to a lot of other sectors. This year, we just did a quick tally, and for the year-to-date period, we're already at 500 million US in the uranium mining equity ETFs. So we've almost matched all of last year in the first 3 months of this year. I think that's a really good sign because I think investors are accurately concluding that this high uranium price and all of the restarts that we're seeing are going to benefit these mining companies. And I also think it's a reflection of risk appetite returning to the sector. And so I think that's another positive. Now, compare that to the capital raised in physical uranium vehicles on the exact same time basis year to date. I think the number, well, it's only us. We've raised about $56 million. So almost 10 times as many dollars has gone into the uranium mining ETFs year to date than the physical trusts and holding vehicles. So again, I think that's also another interesting stat to share with you. Now, you know, I'm putting performance by the wayside. I'm just talking about how people are voting with with their flows.
Hmm.
The other takeaway I would give to you is that the best-selling fund that we have at Sprott year to date is actually the junior uranium mining ETF. And again, I think it's reflective of people saying, hey, the restarts, the higher prices, the fact that many of these juniors haven't sold much or any production forward puts them in a really good position in this market environment. I'm going to buy the junior over the, you know, the all cap product. So we've actually seen very strong flows in the junior uranium mining ETF relative to spot and relative to URNM. And for the members of your audience that are unaware, we also launched the junior uranium mining ETF in Europe with our partner in Han just recently. So on the back of investor demand and requests for that, we launched that fund in Europe.
That's interesting you should mention that because I actually thought there might be sort of a bottleneck. After I talked to a few fund managers last week when I was in Zurich at the Swiss Mining Institute conference. I spoke to there were generalist fund managers from Zurich as well as for Europeans, but they were complaining about it that there's not many options, if you will. As in, sure they could buy
Mhm.
chemical Kazatomprom,
Yeah.
because Kazatomprom actually for a couple of them was completely off the table. But so they could buy Cameco, and then if they wanted a little bit more risk, then they do, Fission, Denison, Next Gen, right? Which are
Mhm.
arguably a comparable. Well, they're a comparable trade only with different valuations, different point. But the point here is there's barely enough space for them to enter the crapshoots, if you will, even though they might want to, right? So long-winded, but what do you make of that? Is that really the case here? Is there a bottleneck for getting large money flows into the uranium juniors, and the money flows that you're seeing? Is that big fund managers, or is it mostly retail and smaller funds?
Yeah, no, that's an absolutely correct assessment. We've been telling people for 2 years that the biggest challenge is investability in the sector.
Mm,
There's just not a lot of large liquid companies that tick the boxes with many of the larger institutions that have very strict parameters, risk management parameters about daily average trading volume or market cap. I often will stumble upon people that will say, "This is a really great thesis. How do I invest in it?" And then they'll say, "I can't buy anything below 5 billion market cap." And I'm like, "Okay, you've got like 3 or 4 things to buy." And that's a real challenge, right? I mean, you can get as excited as you want about the sector. If you can't deploy money, it's a problem. And the reality is it's going to self-correct over time because as the sector recapitalizes, as companies are finally able to raise capital because they're able to get their projects off the ground, they're going to be able to scale and become more liquid and sizable and attract more capital. Now we don't need BlackRock coming in and buying the whole sector for the sector to go up. There's plenty of capital, but it is a challenge in the short term in terms of, how many investors you can tap into. And I think it's one of the reasons why the Uranium Trust has been popular and why the liquidity of that thing has been so good because it is one of the larger, options in the market. And there aren't that many 5 billion plus market cap producers in the market. So it is a challenge. It is a challenge for sure.
mm. What do you think solves that challenge or that bottleneck? Is it just time? Does it sort of solve itself, or like does it get solved in, all at once?
Well, if you think the industry has the opportunity to double production over the next 20 years, and so you think about the capital that will need to come in to these companies, um, it's going to be material. And I think that's how it gets solved. So if the industry wants to solve, or, if the nuclear energy industry and the governments want to solve for this problem of having security of supply with fuel, we're going to need a doubling of production.
Mm.
And that doubling of production is going to require massive amounts of capital. And who's going to provide the capital is it's going to be shareholders, and they're going to fund the right projects with the right rates of return. What governments seem to be putting their money into in terms of supporting all of this seems to be more at the fuel chain cycle, meaning governments are throwing money to support the reshoring of enrichment and conversion. Just the other day, the Biden administration said they would loan $1.5 billion to the Palisades nuclear power station, which is going to be the first nuclear power plant ever closed in the U.S. to reopen. It's a pretty astounding news development that the government at the state level and the federal level wants the power station to come back on. So they've just made an announcement a couple days ago to about $1.5 billion loan. That's really exciting. I think that tells you how focused they are in terms of standing up their nuclear energy sector and reshoring the fuel chain with there's 2.7 billion in funds earmarked to help reshore nuclear fuel, not just LEU but HALEU too as well to support SMR development.
I'm also thinking about how you work that into a supply and demand model. I mean, take yours, for example. It seems to sort of just take the company's word for it. Like, for example, NextGen is saying that they'll deliver over 20 million pounds in 2028, which is obviously it's in their interest to say that to attract shareholders. But is there enough capital? Is the licensing going to be on time and all that? Because that's what, less than 4 years away from today, and there's not even a shovel on Rook One, right? So how do you deal with supply and demand models in the first place, knowing that the availability of capital is a bottleneck, and it's going to be a bottleneck?
Yeah, well, listen, just because a company has the name uranium in it and we're in a bull market doesn't mean, all boats are going to float. But what we've seen in mining generally is that the best projects and the safest jurisdictions are at the front of the line in terms of raising capital. And that particular project, obviously, people are touting as one of the best in terms of its ore body size and grade. But it's not the only one. I mean, I think the Athabasca Basin is going to be a huge beneficiary because it has a long history of producing a lot of uranium. It's in a tier one mining jurisdiction with very good mining laws, very stringent environmental permitting, which obviously takes longer, but I think investors feel more comfortable that they're not going to wake up one day and find out they've got some kind of environmental disaster on their hands. So I think places like Australia and Canada are going to be big beneficiaries in terms of, this kind of reshoring of uranium mining, for sure. And there's obviously a lot of promising projects that I'm not an expert on, so I'm not going to comment on them. But I think the industry is very well positioned to raise capital if it has, large scale, high value deposits that can be built. And I think the industry is really looking to that particular next gen project as one of the mines that could close the supply gap in the next few years. And who knows what the timeline is going to be, but it is the most sizable new project in terms of greenfield that can be built, and we're hopeful it will be built in this cycle.
Mm. What you're saying here, what you're mentioning about the liquidity and the next gen topic is potentially a podcast in and of itself. There's a couple of guys that are moving there in terms of permits. There's interesting things happening as well. Um, but I'm kind of stuck here to what you previously said or what I wrote down about liquidity being kind of an issue for the bigger boys. And it becomes an even bigger issue if you want to short the space, right? And we talked about Spud potentially lending out pounds earlier. You said you don't want to do that. But what about borrowing shares from URNM and URNJ? Does that happen?
There is an arrangement with State Street, who's the custodian, where we do put some shares into the pool. It's very small. I don't have line of sight on what they do because it's at the custodian level. But there is a small portion of the fund that can be loaned out from time to time. We have strict parameters on that. I get reports on it maybe once a quarter, and it's quite de minimis in terms of the overall percentage of the fund.
Okay. So what is that? Well, you get paid to do that as far as I've never shorted anything, so I don't exactly know how it works. But
Nor have I.
okay, have you? So what do you get? URNJ basically gets paid to give its share. Like, how does that work?
Yeah, so most ETFs enter into securities lending arrangements with their custodians. So basically, what you say to the custodian is, look, if you want to use these shares to lend out to somebody, they're available to you with obviously certain restrictions and limitations.
Mm.
And the reason why people do it is you can generate income, and I believe 80% of the income goes back to the ETF. The custodian takes, I think, 20% or something like that.
Okay.
So a lot of ETFs do this. It happens. It's quite common. Um, and it's something I know we've engaged with or in a limited way. And I can't give you the exact numbers, but I think it's somewhere in the single digit percentages of the fund at any given time, maybe loaned out. Sometimes it's just one company or two, but it is a very common practice in the ETF to generate income and offset expenses.
I'm trying to understand how that benefits shareholders of the ETF because you essentially buy the ETF because you want it to go up. You don't want, and it's not going to go up if there's heavy shorting, of course. So where's the benefit to shareholders here?
Yeah, look, you raise a good point. I mean, it is a little counterintuitive in terms of whether a shareholder should lend out their shares. It is something that I think we have to be mindful of, and it's something we will take away. There's some names that we put on restriction lists as well, where we just say, look, we don't want you to short any, or we don't want you to lend any shares out to companies that are too small or whatever.
Okay.
I don't have the exact specifics, but I know we built a number of constraints in with our custodian.
Okay. Fair. But then is that something that helps you keep the cost? Because every ETF has like I don't typically invest in ETF, so I
Mm.
maybe out of my depth here, but there's typically a cost, a management fee to an ETF. Does lending out the shares help you keep a lower cost or something like that?
Yeah, because the whatever lending revenue you receive goes back to the shareholders. So it
Okay.
helps offset the cost. But I think the main takeaway I would leave with you is that it doesn't happen extensively. In terms of a percentage of the overall portfolio, it's quite small, and
Mm,
it's infrequent too. The other thing I would mention is that a lot of the what we've seen in a lot of the funds is that the larger the funds typically the larger the fund typically there's more lending that goes on, meaning the largest fund in the sector typically is front of the line in terms of a source of lending.
mm,
That's been our experience.
okay. Yeah. It's interesting how these things work. And I'm also wondering, and by the way, I realize you might be tired of looking at my face for what is it, about an hour and 15 minutes or something like that. But um, what are these people asking? Like when you get on the phone and do
Mhm.
these dozen meetings or whatever it might be with people that are way more experienced than me, what kind of questions are you getting? Like, is it more sophisticated dynamics type of questions, or are they still mostly in the face of, oh, but what about the waste type of questions?
Yeah, no, those days are gone, thankfully.
Mm,
It's really mixed. It's everything from investors we've had for 3 years that want to get color on what's going on in the spot market, the term market. Um, and then it's the polar opposite, which is, can you walk through Uranium 101 with me? It really varies. I would say we've been doing more Uranium 101 the last 3 months for sure. Well, probably the last 9 months. Um, and it's sometimes you feel like a broken record, but it is important because what you have to realize is that it's opaque industry. Somebody is going to their boss or investment committee or CIO and making the case to invest in uranium. And it's like, where do you start? Where do you get the information? Where do you get, and yes, there's some really good sell side analysts, but a lot of this information you need is, paid. You need to pay to get it, and it's not readily accessible. So we help them fill in the gaps in terms of helping them understand how the term market works, or tell me about the spot market, tell me about the fuel chain, blah, blah, blah. So we get into a lot of those basic, we call them teach-ins. You feel like you're a teacher. But it's important because you have kind of a lost decade of where nobody cared about the sector and a lot of knowledge was lost. And I can say that right across the whole ecosystem, whether you're in the mining space or whether you're running or you're building nuclear power stations or whether you're investing in the category. It was kind of a lost, decade. So we do a lot of that. And thankfully we've got great insights through all of our work daily and our technical advisory team that are constantly interacting with the ecosystem and different utilities and traders and help us, piece together what's going on. And, I think one of the reasons why we've been successful is we've been incredibly focused on this education. And we've been incredibly focused on being transparent around what we do. I do tons of these interviews, as you know. I try to be as candid as I can. And I think people really appreciate the access that we provide to people and the intelligence, the market intelligence we provide to people. And if they buy our funds, great. And if they don't buy their funds, that's fine too.
mm. That's a fair point. I think at the beginning I also mentioned that I wanted to talk about copper and stuff like that, but it seems like that might be for another time. That might be a podcast in and of itself because I saw you somewhere in an interview. You said something along the lines of copper is the next uranium something something, and I'm putting words in your mouth here, so I don't want to do that. But yeah, I really appreciate your time, John. Thank you so much for sitting down with me. Something that I'm forgetting to ask you about uranium that you wanted to talk about today.
Yeah, I would just say focus on the long-term fundamentals. The thesis is totally intact. Volatility is here. It's not going to go away.
Mm,
We saw volatility and we saw sentiment washout last summer. And I know I talked to some investors that got frustrated and sold their positions in July, and then look what happened. So this sector can move quickly, um, but we think the long-term trend looks very positive. And so you have to stay invested and you have to, dollar cost average at times and you have to be diversified. I mean, I think some of these individual companies are early stage. They're in jurisdictions that have additional risks. So you got to be careful about putting too many eggs in one basket, so to speak. So being diversified, I think, is good, but we don't think anything's changed. I mean, we constantly test ourselves and talk to institutions that say, what am I missing? Have I missed something? Has something changed? They rebuild their models from scratch all the time to make sure they're testing themselves. And most of the institutions we've talked to are like, yep, it's just an air pocket, just a noise, just a little bit of a correction, and the fundamentals haven't changed.
Mm. I appreciate that, John, and I appreciate your time. Thank you so much for sitting down with me. It's sprott.com. Right on the front page, you're going to be able to see the different ETFs if people are interested in going and reading up more about them. And they should, because it's a complicated space that involves risk. But yeah, John, thanks so much for sitting down with me.
Thanks for having me. Appreciate it.